In the hot seat this evening is Miranda van Rensburg, Head of Manager Research at Absa Multi Management. Thanks very much for joining us.
Good evening.
We're looking at what you're seeing out there from a unit trust perspective, and the headline of what you've put through is that perhaps when people are looking for diversification, what they're being offered isn't as diversified as they may interpret.
Yes.
Is that the right terminology?
Yeah. Obviously, you know, this whole thing of not putting your eggs in one basket is what everybody talks about. But if you actually start looking at the top 10 holdings of some of the very popular unit trusts, it actually is quite surprising how similar they are at this stage. If you look at, there's about 5 shares that actually occur sort of across the board in the top 10, and they typically on average make up about 26% of those funds. So very, very similar if you look at it that way.
So just packaged slightly differently. That's what we're saying here, is that you're actually buying the same thing across the top 10 unit trusts.
Obviously, you have to look at the fact that many of those funds have as a mandate to measure against the all share, and those 5 shares are heavily weighted in the all share. So
well, that's what I wanted to ask you. Is it, we're talking general equity
yes,
funds here?
We are talking general equity, so you know it is relative to the all share. So where a fund manager might not like Anglos, they might hold 6%, you know, instead of 10% or whatever. But the fact is, for the end user, they are holding a lot of Anglos.
Because if I understand it correctly, the benchmark is SWIX for most of the multi-managers, because otherwise Anglos would be 25% of most portfolios. Yeah,
exactly. You know, but it's a significant portion of many of those funds.
Like so what is the differentiator then? I mean, if you look at that basket and there's not much from a content perspective to diversify, it's got to be on fees and performance. But performance is going to be the same because everybody's got the same exposure.
Top 10, you know, the top 10 looks very similar. Obviously, we have to look, and we as a multi-manager look very much as diversification. So the portfolio needs to be diversified. And I heard you talking earlier about Pinnacle, for instance, something like that. You know, including different kind of shares in your portfolio that can make a difference.
I mean, the big issue, of course, for most of my multi-managers is the size of the tail.
Absolutely.
You know, how many shares sit in that tail outside of the top 10. Now, most people sit with tails of 35 to 40 shares at a time, and then others are sitting with 15 shares, 15 to 20. Now, of the funds 1 to 9 that you've got over here, are there those with short tails? And therefore, that would change the performance outlook.
It would. I think another factor that's very important is to look at this. Typically, the size of the asset manager often gives you an indication of where they can kind of buy in the market. So many of the boutique managers are able to buy some of the smaller shares, you know, sort of more niche shares that might behave very differently from the rest of the market.
I know I'm being very slow tonight, but the terminology tail, should I immediately know what you're talking about? I mean, I understand that it's shares beyond the traditional or your top 10. Actually, I don't have a clue what you're talking about.
It really is outside of your top 20. Just a bit of background. When fund managers evaluate each other internally, the big issue is always looking at the size of the shares sitting outside the top 20. That's called
when you say
tail.
Size, the number of shares sitting outside of the top 20.
In the portfolio.
In the portfolio.
Yeah. So, and sometimes when teams of fund managers, as we did at Stanlib, test each other, we really look at shares outside of the top 10 holdings.
Which is where you said Pinnacle. Those kind of shares make a big difference because they could be your 10 baggers down the road and really give a kicker in terms of performance.
Yeah, and if you look at sort of unconstrained kind of mandates, that's where a manager can really kind of go for, you know, it might be a small share, but he really has conviction in that share and sort of buy a big portion of that. If he's small enough to, you know, to manage a significant portion in that share.
I mean, for a 1 billion rand fund, it's easy to get 5 to 6% of Pinnacle in the portfolio. For a 10 billion rand fund, you're not going to get there because of liquidity. So you do have liquidity constraints within this analysis. But I guess if you went into groupings such as the value fund managers, the growth fund managers, that's where it becomes interesting, and that's where differences in performances
is that nimbleness important?
I think the only thing is in South Africa, the value growth, you know, we're such a small market that the overlap in value and growth is so big that you can't really sort of distinguish on value and growth anymore. There's very, you know, these days we talk to managers and just about everybody's a value manager. So you've got to sort of, you know, it's sort of changed. So that is not really where we see a distinction, but definitely in terms of the size of the managers, that's where the opportunity lies, I think.
Recently, I was chatting to one of the team members from Investment Solutions who was saying that people really, or fund managers, have to start thinking out of the box. They're going to have to start looking at property options. Absolutely. They're going to start, I mean, we even went as far as saying, whiskey. I mean, you've got to really think laterally to be able to differentiate and also to perform in this relatively low yield environment that everybody's throwing around. Is that a view that you share?
Definitely. We looked at that recently, and in a negative real rate scenario, you need to look at kind of different opportunities of where those returns are going to come from, because it's not going to be the normal stuff, and I think the managers are going to have to be very agile in terms of how they do things. Yeah,
but it's the mandates that really hold the fund managers back. I mean, no chance of us buying whiskey.
Crates of whiskey.
Absolutely.
Sugar
but maybe the mandates need to change.
Well, and that goes back to your trustees, etc., and of course the Reg 28. I mean, we're really bound by Reg 28 when it comes to managing pension fund money. I guess a unit trust can be created, and that's got to go through another process whereby you're allowed to have up to 20 to 30% of unlisted investments, because then you're talking things such as diamonds and other exotics.
All right, let's be more realistic. With the stringent regulations, should we even be having that conversation saying fund managers need to be more creative? Because the bottom line is that they can't in the current constraints. I mean,
yeah, I think within equity funds, looking at those smaller shares, I think is where the opportunity is. Obviously, if you start looking more at asset allocation kind of funds, then you start looking at the ILBs and the commodities and.
But the smaller shares are only available to the smaller fund managers, as you pointed out.
Well, depending on the size of the fund, you will put certain shares into those funds. Now, you have a lot of attractive companies with market caps of under 2 billion rand right now, and when you speak to the individual management teams, they're growth opportunities. But a guy who's running the Coronation Fund, the Allan Gray Fund, the Stanley Fund, they're going to have no chance, because it'll make up less than 1% of their portfolios.
Miranda, just as we close out, any overriding issue that you would like to point out for us?
No, I just think that's where the opportunity is for multi-managers to kind of blend those managers that do bring different things to the party and kind of bring the risk down, but still have a return there.